Okay, good evening, everybody. Welcome again to our Money and Medicine uh, talk for this evening. Oops. Okay, wait. I'm Dr. Ganitano, and the topic of my discussion tonight is called wealth accumulation. And again, I'm with Philippine Med Association's mentorship program, and I consider myself a newbie. Um, so when I put this talk together, I really struggled to figure out how am I going to pull all this different information together. And I just felt that the easiest way is to go back to our original concept for this series, which is doctors talking to other doctors about what we did and what we probably could have done better from the beginning. So I just wanted to start with my story a little bit. Again, I'm Emilio Ganitano. I was born in Honolulu and I grew up in Waipahu in Aiea, the Royal Summit place. My parents are both immigrants from the Philippines. My dad is a welder. He owned a small business making ornamental fences. So if you go all around Waipahu, a lot of people's houses have fences that him or the people he brought in the business built. But his main job was a welder at Pearl Harbor Naval Shipyard. My mom was a nurse at St. Francis Med Center, which has come and gone, but us old timers remember it. She also worked as a manager at Liberty Dialysis, and in retirement, she owns an advanced case management, which is a case management for foster homes. So for me, my parents have always worked really hard between the businesses. My dad probably worked 7 days a week, multiple jobs per day. And my mom, worked a lot growing up. And her main job obviously was to run the household, which was what she thought was her main job. So again, hardworking parents to really set the example for us. I have one brother. He's a construction manager at Hensel Phelps in Hawaii. So completely opposite for me. My sister-in-law is a clinical pharmacist at Polymomi, and my nephew loves to do puzzles. He's a cool puzzle guy. So growing up, we thought about what is this concept of wealth, and for us, we didn't have a lot of money growing up, being a working class family. So to us, wealth was family being able to get food on the table, a nice roof over our heads. And when later on, as things progressed, I mean, the concept of wealth in our mind is how much money can you have in the bank and maybe some real estate here and there. But I think for my family, the big investment we made with our money was really in education. And to this day, we still value that as probably our biggest investment as a family. I went I didn't go public school. I went private school. I went to St. Louis. And then after that, I went to University of Notre Dame, where I graduated in 95. And my parents really did a great job because they sent me all through public school. I never had to get any help with that at all. And I was fortunate because they paid my whole undergrad. So they covered tuition, room, board, anything I needed in undergrad. And in their mind, that was part of their investment strategy for the future. And it was really successful. I went to JABSOM. I graduated in 99. For the med students, these were my classmates. We're now you guys professors, but Damon and Vanessa are examples of our class in 99. So, in a lot of ways, I'm actually the same as a lot of you. I came from probably very similar backgrounds. And, what is this, 20 plus years ago, I kind of was exactly where the MS4s were, So in that sense, I wanted to talk about my disclaimer. So again, I started off where many of you are. I'm not a financial professional or a financial advisor. I don't have any formal training in finance. Everything I have to say today is informational and for your entertainment. Hopefully it's not a comedy tonight and that you guys are laughing too much. But what I really want you to do is take what you learned tonight and then go back and talk to the people that you have involved in your own finances and see how much of this advice can help you. And at the end of the day, I'm a doctor sharing his experiences with you and hoping that you can at least learn from all the things that I wish I knew at your age. And a lot of things like I wish I could turn back time and do. So hopefully some of the things I talk about tonight will be things that you're gonna learn from. So taking it back to last week's talk, Hazel and Terry talked about asset protection. And that's really a solid foundation you need to put in place, because if you try to build wealth without a solid foundation, it's going to collapse if something catastrophic happens. So I would really pay attention to what we spoke about last week and build your asset protection things in place before you even think about accumulating wealth. So again, what is wealth? I think this is a really important question. You know, is wealth high income? You know, we were talking about our K1s ready for our taxes. And, you know, as physicians, you're going to be considered a high income earner, right? When you're a med student and you're looking at the fact that I might make $60,000 a year, you're probably going, wow, that's like a lot of money. I'm making 60 grand. I've never made 60 grand in my life. But if you go by per hour, which I would advise you never to figure out, don't do it, because you're going to end up making less than minimum wage. But when you come out, depending on what you want to do, primary care doctors in the US average $243,000 a year, and specialists will average 346, and some specialists will even average even more, up to like 700, 800,000 a year. So just really depends on how hard you work and what field you are. But does income itself equal wealth? And that's one question to ask. Is wealth having fancy stuff? For those of you that don't know, Rolex is not the only fancy watches out there. And, you know, this is actually a really interesting brand of watch if you're ever interested. Is it having fancy cars? You know, another thing. Or is it having the fancy house? I wish I had this one. I do not. But this is on, I think it's Portlock or something. It's like 12 million bucks. But, you know, is that wealth if you have this house? I don't know. But again, there's a lot of different ways in which wealth is defined. Dr. Housel, who wrote The Psychology of Money, said, you know, being rich is about current income. So if you see someone driving a fancy car, that guy has to be rich because he needed enough money to buy that car. But true wealth is hidden. It's income not spent. It's the option not yet taken to buy something later. So it's really, wealth is the value that gives you options, flexibility, and growth to grow one day and purchase more stuff than you can now. So are you building wealth? But a more practical way to look at wealth is this concept of net worth. So net worth equals assets minus liabilities. In a famous book called The Millionaire Next Door, they define wealthy as a net worth of greater than $1 million, for example. But, you know, we'll talk about that a little more. But to define some of the other things, again, wealth is assets minus your liabilities. An asset is something that puts money in my pocket. So stocks, bonds, mutual funds, real estate, and to a certain extent, savings, are things that you put money toward that hopefully will bring money back in the future. And a liability is something that takes money out of your pocket. So your mortgage that you have on your real estate, car loans, credit card debts, school loans, etc., they're liabilities. And you know, our goal in life is to actually try to invest more in assets than in liabilities. So again, accumulating wealth, conceptually it's easy, right? Build plenty of assets, limit your liabilities, where the big difference will increase your net worth. Right there, wealth accumulation, that's all we need to know, right? Sounds easy, but in reality, maybe not so much. So when you look at this Medscape study, and Hazel talked about it last week, 50% of physicians have a net worth less than 1 million. About 42%, their net worth is between 1 to 5 million. And very few, about 8%, will actually have a net worth greater than 5 million. So 50% with a net worth less than 1 million, you know, in Hawaii, that's not a lot. This simple house, almost $1 million, right? And that's just the house part. So, you know, it's really interesting because, you know, physicians, we're smart, we're high achieving, you know, in college, we're the top of your class, you're the top 1%. We normally have excellent analytical skills. So why doesn't this intelligence translate into wealth accumulation for physicians, right? That's the question you got to ask yourself. So I want you to think about this story. So, you know, this is a story of Ronald James Reed. This gentleman is a true story. He was born in Vermont in 1921. He's the first person in his family to ever graduate high school. He never went to college. He fixed cars at a gas station for 25 years. He swept floors at J.C. Penney, which is a department store, because we don't have J.C. Penney. I don't know if you guys remember that. For 17 years, and he lived in a really, very simple house in Vermont for $12,000. But Mr. Reed, he made the news in 2014 because when he died, he was worth $8 million. And in that year, out of all the people in the US who died, only 4,000 people had a worth of $8 million or more. So he was really wealthy, at least from a net worth standpoint. And you have to ask, well, how did this guy get there? Did he win the lottery and got there? No. Did he win megabucks on the slot machine? No. Did he inherit it? No. Was he a genius investor? Absolutely not. But the reason he was so wealthy at the end and his net worth is so much is because he lived a reasonable life and he put money away with every check into blue chip stocks. So the take-home message here, it's not about intelligence. You don't have to be the smartest person. You don't have to understand stocks and be the person that predicts everything. You just have to have good behavior, because behavior trumps intelligence when it comes to finances and wealth accumulation. Dave Ramsey, who's one of these favorite, bloggers and writers on finance, said success in personal finance is 80% behavior and only 20% head knowledge. So again, it's well within your grasp, even if you're not intelligent about money. It's all about behavior, and I want to expand on some of this going forward. So there's a lot of different behavior out there that can lead toward increased wealth accumulation. But I think the simplest one was put forth in J.L. Collins' book, The Simple Path to Wealth. And this is like the number one thing in the introduction. He basically said the secret or a simple path to wealth is easy. Spend less than you earn, invest the surplus, and avoid debt, right? Super easy concept. So when I graduated med school, again, my story, I went to UH internal medicine here, and I lived at home, so I was able to save a little bit, but I honestly spent a lot of money as a resident. I enjoyed life. I went out and ate a lot. Back then we lucked out because the drug reps paid for pretty much everything. So we just spent all our money on fun things. So we ate at a lot of restaurants. We took fancy trips. And I'll be honest, even though I got a decent amount of pay, I didn't pay down my student loans. I just found ways to just defer, consolidate, figuring, I got time to pay that later. And I built up a lot of credit card debt because, when you're a brand new resident, every day in the mail, you get an offer for a new credit card and you end up spending it. And I have to admit, I was pretty irresponsible as much as I could be, I guess, without going absolutely crazy. I ended up going to University of Pittsburgh for my critical care fellowship, which is Pitt CCM. And Pittsburgh, unlike Hawaii, was very different. So for one, I had to live on my own, so I had to pay rent, which I didn't do in my residency program. And the big thing that's going to happen, especially those of you that stay here and you go away for fellowship, you go from making like $70,000 a year as chief resident in Hawaii to making $50,000 as a first-year fellow. Take a $20,000 pay cut. So as a fellow, it was rough because I had a lot of credit card debt to pay. My loans started becoming things I had to pay. And honestly, at the end of each month, I was eating a couple of noodles to finish off the month because I didn't have enough money. And that didn't get fixed until it was a second-year fellow and I could moonlight and I doubled my salary. So again, a lot of stuff you can, a lot of traps out there when you're a trainee because you're just honestly trying to survive. You're trying to balance the work hard with play hard. And that's some of the challenges you're going to face going forward, but you have to probably look at it a little more smarter than I did. But, I thought, okay, well, I finished fellowship, going to be an attending. I got it, no worries. This is going to really solve all my problems because, the amount of money I make are going to go up. But a lot of you are going to find out that this is honestly the typical path of the doctor. You're going to have resident level income and resident level expenses and resident level liabilities. Your income's going to go up, but guess what? A lot of times your expenses go up. Your liabilities go up with it. So even though you're making more income, income does not equal wealth because you're actually your expenses start outpacing your new income. And again, this is common, right? Because number one is the whole FOMO, fear of missing out. All of your friends that aren't doctors, they all bought their houses, you know, they all have their careers that are they're 5 or 6 years into their career. And when you come out as a brand new attendant, you want to try catch up with all those guys, right? You're tired of seeing your friends that work for the bank or wherever else but medicine already have the things that you wanted for a long time. So a lot of times your initial thought right out of residency is to try catch up. There's a keeping up with the Joneses concept. So, hey, one of my partners in my group, Dr. Trivedi, he just bought a Tesla Model Y. I want one of those. He has one. I should buy one too. So how do I keep up with the Joneses? That's another pressure you're going to face. And then my favorite is the whole attending life thing. And I still remember telling some of my friends when they first came out of fellowship, why are you driving that car? And the car is breaking down. Go buy a new car. You're an attending. You deserve it, right? And there's an expectation when you're a physician. You don't want to have the most rundown car in the doctor's parking lot, especially when all the cars around you are nice, right? And the other part of being an attending, especially after a year or two, is like, I work hard. I sacrificed a lot. I deserve those things, right? So I need to spend and buy things that are cool because I'm an attending. And then there's a lot of people you meet that have the full YOLO, the old you only live once because I got to live it up now because someday I could get hit by a bus. And if I didn't have, disability or life insurance, then I didn't enjoy my life. So there's all these pressures that are going to come out when you start finishing residency and become an attending, and this is going to increase a lot of your expenses and liabilities. So I guess one way to look at this or try to not fall into this trap is this advice that came out of this book called The Richest Man in Babylon, and this is a second cure for a lean purse. And he's basically, the advice here is control thy expenditures, right? So whatever you call as necessary will always grow equal to our income. So unless you do something about it, right? So if you don't control it, all the things you think are necessary is going to cost more than the actual money you make. So again, you really got to be careful not to confuse necessary expenses with just the things you desire. Do you really need that new car? You need a car, but you really need to have that car right away, for example. You're going to have to really start thinking and how to control your expenditures. But, at the end of the day, I like to think it's grown-up decision time when it comes to this aspect of your life because, we're all human. For some of us, those things I mentioned, it might matter if you want to catch up with your friends. It might matter to keep up with the Joneses. Just depends because, again, we're human. We have desires. We have things that we value. None of this is crazy, but you do have to realize that you cannot do all those things and still accumulate wealth. You're going to have to really figure out what matters to you and what gives us joy and happiness. So I like wearing nice fancy suits. I wear Hugo Boss suits whenever I have to dress up. I drive, I bought fancy cars. I like going to Vegas. I like eating at fancy restaurants because it gives me joy. But at the same time, I'm not going to sacrifice my whole future to do these things. So you got to really balance out accumulating wealth with, the joys in life. So again, I think the bigger advice at this point is to really lead a reasonable lifestyle, right? So are you going to be full on YOLO or super frugal? I wouldn't be happy if I was like some of the people that talk about, financial independence, retire early, where they're just buying used cars all the time. I like my cars. It gives me joy. But at the same time, I'm not going to go crazy and spend all my money, on trips around the world that I don't need. So you really got to think about picking a lifestyle that meets your short, medium, and long-term goals. So I think that's kind of step one. And when you're looking at your spending when you move forward. So how do we get ahead? How do we, continue to build wealth? I think I always like this concept from the White Coat Investor. And he basically said the most important year in a physician's life is your first year out of training. The most important advice that you would find if you ever read this book is live like a resident. So what does this mean? So basically, live like a resident as an attending. So the first 2 to 5 years as an attending, you want to live with the same discipline you had like a resident. So for example, when you're a resident, you made this much income and you made this much expenses. When you become an attending, your income is going to go up. But you know what? Don't change your lifestyle. keep the same number of expenses, keep the same liabilities, and then you're gonna have extra money left over because your income is gonna outpace your expenses. I fortunately was able to do this when I came back from fellowship. I lived at home for maybe 2 or 3 years, rent free. I had to pay my parents back for all their generosity covering my undergrad. So I did things to help around the house. Like I bought a new roof, I got the house painted, I bought washer, dryer. So I bought a few things, but in general, my expenses weren't that much more than when I was a fellow, and I was able to save some extra money. And with that money, what you want to do is apply that to things that could get you ahead. So number one, I paid off all my credit card debt. One fell swoop, one check, done, end of story. What I didn't do, which I wish I should have done, is paid off my student loans in the time I stayed at home. I was one of those people that I said, well, I'm just going to pay the minimum and it's low interest, quote unquote. And I ended up paying that through the years. But I wish in hindsight that extra money, I should have paid student loans. But what I did do is I built my emergency fund, which we talked about. I started some savings from some of my short-term goals, and then I did some investments, but very little. It's more of my short-term goal stuff. So again, I would advise you that, you can buy a few things here and there when you become a new attending, but maybe try to live like a resident for a couple years, build up extra money and pay off all the high interest stuff like credit cards and student loans, get your emergency fund squared away, and then perhaps move out into expanding what you have in your circle. So, they always say one other rule is a 10% rule, which is, spend 10% on completely fun things, and the rest of it you can be responsible with, just to give you a little taste of life. So again, live like a resident would be another piece of advice that I would totally do. The first cure for a lean purse, which is, sorry, it's kind of out of order, but in The Richest Man in Babylon he said, for every 10 coins that you place within your purse, take out for use only 9 of them, meaning and basically your purse will get fatter. So really what this means is pay yourself. So most people, when they get an income, they pay their bills, right? They pay all the essential stuff, your credit card debt, student loans, food, car payments. Then they have some fun. And then lastly, with whatever's left over, hey, let me put that into some kind of assets or investment. And this is a concept of pay everyone else first. But really what they were saying in that first rule is you should change it around. So for your assets, at least 10%, if not more, of your income, you should pay it to yourself. And it's really paying your future self before you pay your current self. So figure out in your budget how much you can put away, put money into whatever your investments are first, then pay your bills, and then with the leftover you have for entertainment and fun. So again, changing this concept from paying everybody else first to paying yourself first. So for me, it was half-half. I think I was smart enough, or I was lucky enough, I had good mentors to a certain extent where they say, whatever you do, max out your retirement first before you spend money on anything else, which I did. What I probably could have done better is address other assets first, which I didn't. I just saved money, paid my bills, and then kind of had fun at the end. So changing this concept again to pay yourself first in addition to live like a resident, I think is really important to helping yourself build your assets over time. So again, commit yourself to a certain percentage with each month. Pay this before paying other expenses. You may have to adjust how much expenses you have so you can prioritize this payment. But the other thing to think about doing is automate everything. You can automate so much stuff now. You can automate how much money is pulled out of your account and put into mutual funds. You can automate how much money is pulled out of your account and put into your retirement. And what I'll tell you is after years, like I used to pull money for certain investments, after a few years, you forget that money is going anywhere. So you're not going to even miss it because you never saw it to begin with. Then after a while, you're going to go and realize how much money you saved because, I didn't even miss that money. And you don't touch it because again, you're not going to miss what you don't see. So again, automate some of your deductions to pay yourself first. So again, spend less than you earn, invest the surplus, and avoid debt. So Any questions, Hazel, out there that I could answer now, or okay?
Nothing yet.
Okay. So hopefully it means it's all clear or it's too confusing. I'm not sure which one. Okay, so I'm gonna go briefly into what I personally consider the most boring part of my talk, and yet it's super important and stuff I personally didn't understand. So the first thing is, in this, Benjamin Franklin said, in this world, nothing is said to be certain except death and taxes. Okay, so not gonna talk about death, but we're gonna talk about taxes a little bit. So taxes, as I discovered probably later in my career, there's a lot of them. We pay a lot of taxes, right? There's payroll tax or FICA. We have federal income tax. If you live in Hawaii, there's state tax. And then there's this thing called capital gains tax, which we all pay. Okay. So when I was in high school, my first job was I was a luggage salesman at Sears Ala Moana. And I remember getting my first check. And the first thing I said is, one, well, why is my check so little? And then my second question was, what the heck is FICA? Or what the F is FICA? And when you get a job, you're gonna find this thing called FICA, and it stands for Federal Insurance Contribution Act. And it's divided into two parts. So first is Social Security tax. So even before you get paid, even before you pay taxes on income tax on it, even before you take any deductions on your income, you're taxed with FICA. So number one is Social Security tax. So Social Security tax is 12.4% of your gross earnings. So half of it, your employer, instead of giving the money to you, just pays out to FICA. And the other half, it's still your money, but they make you pay it. So it seems like it's coming from you and you have no choice. So it's 6% of your gross. It's actually 12.4% of your gross earnings up to the first $142,800 of your earnings. So if you make more than $142,800, anything after that is not going to get taxed Social Security. So most physicians make in the 200,000 range. So basically, you're going to maximize your Social Security tax for the majority of your career. The second part of FICA is Medicare tax. So 2.9% of your gross earnings total, but you as an employee will contribute 1.4% out of your check to Medicare tax. But because you make more than $200,000, we have more money to pay, I guess. You're going to add up 0.9%. So in reality, as physicians, you pay 2.35% Medicare tax. So your overall FICA is like 15%, and that's even before it gets paid to you. So automatically, we're paying a lot of money. So I don't mind charging Medicare patients because, they're basically paying me back for all the money I spent on them. So, I don't mind taking care of Medicare patients because you got to pay me for the money I'm giving them. But this is FICA and you all will pay this, okay? So now that they deduct the FICA, you finally get paid, right? So this is called income tax. So the misconception about income tax is this concept of income bracket. So like, for example, I'm in the 37th percent income tax bracket. And I used to think that meant my whole income was taxed at 37%. So they would take away 37% of my money. But fortunately, it's actually not that bad because income brackets are actually income pockets. So this is how to explain it. I just chose buckets as this thing. So for your first $9,875, right? So say you made $300,000. The first $9,875 is taxed at 10%. The next amount of money, which goes from $9,800 to $40,000, is taxed at 12%. And so on and so forth until you get to $300,000. So the difference here will be taxed at 35%. So again, it's not your whole income taxed at 37%. It's just all these different buckets along the way. So to illustrate, if you made $300,000, 0 to 9,875 is going to be times 10%. So you pay $985 on the first 9,875. The second bucket, because you filled the whole bucket, we're going to pay $3,600 and change. The next amount of money, the 40 to 80, you're going to pay $9,000. The next amount is probably one of the bigger amounts. You're going to pay $18,000. And then we're going to get up to this amount, 163 to 207. We filled the bucket again times 32% is this amount. And then the last bucket, because you're only making 300,000, the difference, which is 92,000, will be multiplied by 35%, and that will give you the tax at that time. So 32%. So again, the more money you make, the higher the taxes is on the latter part of the bucket. So hopefully that makes sense. If we put it in a table form, again, if you made $300,000, this is how much taxes you owe. And again, for here, it's 9,649 times 35% will give you that. Again, you didn't make over 518, so nothing is charged at the 37% tax bracket. But all of this is what you owe. So $79,000. So you made $300,000 out of that. This is the amount of money that you would owe the federal government in taxes. So the way you figure out how much you actually paid the government in taxes on your income is you take this tax owed divided by your income, and that'll actually give you how much you paid. So even though you're technically in the 35th tax bracket, you only paid them 27%. Okay, so that's taxes. So hopefully we don't have a lot of questions on the income tax. The price of paradise. So Hawaii has state taxes. Other states like Washington State, there's no state income tax. It's great. But we have it, and we have a progressive tax similar to a federal income tax. I didn't break down all the buckets, but the highest marginal tax rate in Hawaii is above 200,000. So just making over 200,000, you're already at Hawaii's highest tax rate. And if you saw in the news, they want to increase it so that if you're making greater than 200,000, the last part of your money is going to be 16% tax rate, which coupled with our federal tax rate will be making us pay actual taxes pretty close to 50%. So if you think about it, all that money you're going to make, half of it, you're going to give away to the government. And if you're in private practice, you pay get tax, which is general excise tax, which is the state wants to get my money because they want to charge me even more. And it's 4% on business activity. So for example, when I do billing and I bill for services, I still got to pay 4% taxes to the government in addition to everything else, right? And we won't even talk about how the insurance companies don't pay us everything anyway. But that's the price of paradise. So hopefully it's worth it. Otherwise, you're gonna have to really think about where you want to live. So again, FICA, income tax, state tax, that's all the money that's gonna get taken out of your check before you can invest it anywhere. So there's a lot of taxes that are taken out. So they always talk about income doesn't equal wealth, but if you have higher income, at least that makes it a little easier in the long run, because you'll have maybe a little more at the end of the day. But again, we'll see. Capital gains tax. So the concept here is when you win, you still lose. So capital gains tax is you invest all your money and it grows, but guess what? The government wants a part of that growth, right? They want to charge you for it. So anytime you make money on stocks, bonds, jewelry, real estate property to a certain extent, or you get paid dividends by your investments, the government is going to take some of that for themselves. So there's short-term versus long-term capital gains tax. Short-term is if you held the investment for 1 year, they're going to tax you at the same rate you make your income now. So for me, I'm at a 37% tax rate. And if I invest in Tesla and I sell it tomorrow and I only had it for like a week, they're going to charge me taxes on that gain at my 37% tax bracket. Long-term capital gains tax, if you had an investment for more than 1 year, do you want to give you benefit for investing longer term? So this is also based on how much you make. So if you made $0 to $40,000 in your normal income, they don't charge you anything. If you're in this range, they're going to charge you 15%. And if you make more than 441,000, then any capital gains you make over a year, it'll be charged 20%. But 20%, this person would probably be in the 37th tax bracket on ordinary income. So that's at least a 17% improvement. So I think that part is, again, it benefits you to keep your investments in for more than a year. Okay. So before I move on, is there any questions about that? No. So I'm either really confusing or really clear. I'm hoping I'm really clear. Okay. So the third cure for a lean purse is make thy gold multiply. So what this means is the earnings you make should build your fortune. So you basically need to make your money work for you is the bottom line of this. And that is this concept of compound interest, right? So Albert Einstein, a lot of people said he didn't actually say this, but it's frequently attributed to him, said that compound interest is the eighth wonder of the world. So he who understands it earns it, but he who doesn't understand it pays it. So the question is it a friend or foe? So there's two kinds of interest. When you learn about math, you usually learn about simple interest, which is interest paid on principal only. And then there's this concept of compound interest, which is interest paid on interest and interest previously earned. And I remember in high school learning about this and going, why would I ever need this compound interest? It's too complicated, the formula's too crazy, yada, yada. And I basically ignored it. But now that I know more about money, you really want to understand what compound interest. So simple interest. So say we have $10,000 and the interest rate is 10%. And we're going to look at what it's like 30 years from now. So if you take 10% of $10,000, the interest paid in the first year is $1,000, right? So your balance will be 11,000. The next year, they're gonna take 10% and again multiply it by 10K. You're gonna add another $1,000 of interest, so your balance goes up to 12,000 and so on and so forth. So this gives you 40,000 at the end of 30 years, but and your principal kind of stayed the same, but it's kind of based on this, right? This curve. Hey, that's not bad, right? I put in 10,000 in 30 years, it went up by a lot. But now if we look at compound interest, so we take the same thing, 10K, interest at 10%, and my 30-year return is now 174,000. Well, how did I get so high, right? It's like 4 times what the other one was. So again, in compound interest, the first year it's 10% times 10K, it'll give you $1,000 interest, and your balance is 11,000. But now, instead of the 10% being applied to the 10K, this 10% is applied to the 11,000, so that'll create $1,100 in interest, which increases your balance to 12,100. Again, the next year, 10% times this 12,100 will give you more interest, and it'll add to your interest again, and so on and so forth. So when you see the compound interest chart here, in the beginning, it's kind of slow, but in time, you see that the bars and the amount of money you interest per year as you shoot up, it's gonna skyrocket, right? It's gonna grow significantly. So it's really important to utilize this concept of compound interest. So we apply it, again, the comparison is in 30 years, simple interest is 40K versus compound interest is 174,000. This is a great example of your money working better with compound interest. Unfortunately, in most of the things we do in money, compound interest is the rule of the day. So real life example, say compound interest, you have a 401k retirement plan that you're starting your brand new year as a new attending, and you're gonna work for 30 years. Interest is 10%, which is high, but you're gonna contribute a max 401k that's unmatched and no profit sharing, which is 19,500 per year. So if you put that in, at the end of 30 years, you're gonna have $3 million. $3 million at the end of 30 years. But if you start later, you're gonna have less and less, right? So if you started 20 years late, if you started 10 years late, you're only gonna get to $1 million. If you start 15 years late, you're only gonna get to $600,000. So it really is to your advantage to start using the advantage of compound interest earlier in life. So Warren Buffett, who is actually one of the most richest guys in the US, he's worth 85 billion. And he basically earned 90% of that after age 60 because he basically took advantage of compound interest and compounding in all of his investments. So even for you, compound interest is your friend as we move into this concept of wealth accumulation. So again, in one way, it's your friend because it can raise your earnings quickly in stocks, bonds, and savings over time. But on the flip side, it's your enemy. So remember when I talked about how I just paid off my interest, I paid off my student loan because it was low interest. Compound interest hurts you too because that interest, the amount you have to pay in interest also compounds over the years. So you really want to pay your loans down or debt down early so the compounding doesn't affect you, and then put all your money into your investment so the compounding can actually help you. Any questions? I saw anything.
There's a question about taxes. Did you want to answer that now?
Sure, yeah.
Okay. What is your suggestion on how much to take out of your paycheck with withholding allowance? How do you determine how much to withhold? For example, if you take out too little, you have to pay more, and you actually have to pay. You're gonna have penalty versus
Mhm.
taking out too much, and then you get a tax refund. How do you suggest how to determine how much to take out?
That's a great question. I kind of asked myself that question. I just had to do that. I don't, yeah, in a way, I mean, if you don't take out enough, you're going to have to pay. And then, but potentially, I guess it depends on what's important to you. Like for me, I don't like having to pay penalties on anything, and I don't trust myself to necessarily know what those penalties are. So I usually put in a little more and get the refund at the end. The only negative about that is you gave Uncle Sam a free loan, right? And where you didn't earn interest. So I mean, I just honestly just kind of read the thing. It's like, well, I'm single, filing single. I just pick the one that best applies to to my my situation. So I don't have any magic answers for you there. To be honest, I kind of don't know. I don't really think there's a wrong answer, but I don't know, Hazel. What do you think?
I think if you're a resident, it's pretty easy to calculate your taxes, right? You just go onto one of those websites and then you plug in your income and then it'll tell you how much you're going to have to pay in taxes. But once you're in attending and you're starting to make a lot of money, I definitely find value in having a good CPA. And then they're the ones
Yes.
who are going to tell you how much to put in your paychecks or whatnot. But then there's this general rule. It definitely helps after you filed 1 year of taxes. You see how you did in that 1 year, how much taxes you paid, and you use that number to help plan for the next future, for your next year. So like, oh, I paid 50,000 in taxes last year. So now I know moving forward, every paycheck I have to deduct, I have to basically pay 50,000 over the next following year. So that's one way we do it too.
Yeah, and
But
I,
CPA.
I would say I agree with you. Like when you're a resident, you can use TurboTax. When you're attending, you cannot use TurboTax. You'd have to find a good accountant, and we can talk more about that later. Okay. So moving on, finally to the meat of the talk, or more meat of the talk, getting out of behavior and stuff, is this concept of, well, now how do I use all this to accumulate wealth? So a lot of the stuff we talked about in terms of compounding is gonna affect how you build wealth, or at least build assets in terms of your stock, precious metals, real estate, and cryptocurrency to a certain extent. But what you're doing when you're looking at accumulating wealth is you're putting that into this bucket, and then you're kind of letting the bucket simmer and everything cook inside and hopefully grow is hopefully what's going to happen. Kind of getting back to the so-called pyramid of finance. So, Hazel talked about asset protection as your base, and I'm going to talk about wealth accumulation. But one of my financial advisors told me that you can kind of subdivide your wealth accumulation phase into three distinct buckets. So there's your short-term accumulation goals, your long-term accumulation goals, and a middle term. And really, you're forming another pyramid because at a base, you have your asset protection base. The first base you kind of want to address is your short-term and long-term, and then you fill out your middle-term bucket later. And that's because, and we'll explain that right now. So your short-term bucket is probably what you need to fill up, especially like when you're a resident, you need to start planning for this bucket because you're not going to have a ton of extra money, but if you're going to have money, this is the bucket to put it in. Your short-term bucket is really what a lot of people consider their quote-unquote savings. The target is from now until 3 years from now. So this bucket is for money that you're gonna need kind of immediately or right away. In terms of liquidity, meaning your ability to pull it out of whatever you have it in, you need immediate access to it. Because this is money you might depend on today or tomorrow, you don't want it to be in a volatile kind of place. Like you cannot be in the stock market where it's up and down, or in Bitcoin and crypto where it's up and down. You need it to be pretty boring and steady because you might need to call on it in a second's notice. And because of that low volatility, expect the growth in the savings part to be pretty low, right? It's in general pretty low. Because again, the things that you're going to use this short-term bucket for is like your emergency fund. When you're a resident, just try to have the $1,000, or even a student, have the $1,000 in your emergency fund. And then when you're a resident and early attending, then you want to pack away 3 to 6 months in your emergency fund. And this is usually going to sit in your short-term bucket because it needs the same characteristics of stability, immediate access, right? And unfortunately, not a lot of growth. Majority of your short-term bucket is your operations fund, which is your day-to-day, right? This is the money you need to pay your bills, how to live with your day-to-day expenses. So a lot of your money needs to sit there. I can't zero out my bank account because I got to pay for my dinner after this talk is done, for example. And then the last bucket is your savings for short-term buys. So again, 0 to 3 years, are you saving money to go on vacation? Or what if you want to buy a house in 3 years? You cannot really put this money into longer term investments because you're going to have to pull it. It won't have time to grow. So are you going to buy a car in a year? So a lot of this money is going to sit in your short-term bucket as kind of the first part of your wealth accumulation. So the stuff that really goes in your short-term bucket is mostly cash. Sometimes you can do other investments like certificates of deposit, which is called which is our CDs, right? And putting them in there. But majority of the time, you're going to put cash, and you're going to save up cash in some way, shape, or form. We're not putting cash in your drawer or in your mattress. We're going to use a bank. And for me, when I first learned about, growing up, all is brick and mortar for the most part, right? Bank of Hawaii, Central Pacific Bank. These are the First Hawaiian. These are the banks we grew up with. But I'm guessing your generation's actually more in touch with online banking. But we'll talk about that in a second. The pros and cons of, brick and mortar banks, like I like buying local. So, local companies are always good. They have ATMs everywhere. So like I use Bank of Hawaii because I knew all the hospitals had Bank of Hawaii ATMs and I didn't want to pay the $3.50 extra fee when I'm taking out cash. I personally like in-person customer service. If I have a major problem, I want to go to my bank and talk to somebody instead of talking to somebody in India. But the cons with in-person or brick and mortar banking is when it comes to interest rates or savings and stuff like that. So Bank Ohana is where you have your special personal banking level 2, level 3. But look at the interest rates. It's only 0.02%. It's super low. So big con. You're going to put your money in a bank. It's safe. It's insured. It's not going to go anywhere. But at the same time, it's a couch potato. It's going to sit there and do nothing. So again, your generation is probably used to online banking, and there's a lot of them out there. I use Capital One just because I used it when I hooked up with Capital One when it was still ING Direct and it got bought out. And the pros is actually there's a lot of easy access to your computer. I have an app on my phone that can access it. And because you don't have to pay for buildings, there's less fees. And because of less fees, they can do things called high yield savings accounts. And unfortunately, before high yield savings accounts used to be like 3%, but because of the bond rates, they're a lot lower, but they're still better than your 0.01, 0.02. And the cons, again, if you need to get cash, then you get ATM charges. Sometimes if you're moving big amounts of funds from your online to your brick and mortar, so for example, if I wanted to go Vegas and I wanted to draw $3,000 to go Vegas as my bankroll, and I wanted to take it out in cash, there's no Capital One bank in Hawaii. So I would have to move money to my Bank of Hawaii and take out from there. And then that takes a few days. So there's some delay in availability if you're moving between banks. And again, there's no local customer service. And granted, most of the time it's not bad. But again, if you value in-person banking, online banks might not be all for you. So for me, I have both online and in person, and I use it for different things. But again, the high yield savings account, again, Ally 0.5%, which is significantly a lot more than 0.01. American Express, if you want a more brand name, is 0.40. And if you really want like a 3%, talk to Dr. Hazel in private because she can hook you up with something in the Great Lakes or whatever the heck it is. But in general, online banks should be where you put a lot of your savings, and then your checking for your day-to-day could be your brick and mortar account, which is kind of what I do. So again, this is for your short-term money. So one of the things I did, and because I was probably misinformed, is, you know, I did put money into my retirement, but I had some extra money. And, you know, growing up, the concept of, oh, you have extra money, put it in the bank, because, you know, that's what we do. We put money in the bank. And, oh, yeah, you can just leave it in the bank and you save that for your retirement. But again, the problem is, if I put it in the bank even at an Ally, or like at 0.4 in 20 years. So say I started now, 20 years from now, I only gained $40,000 in income, right? Which is not a lot if you think about it. And on top of that, I'm going to get taxed on this the whole way, because they're going to have to pay capital gains tax on it the whole way. So I made a mistake that instead of investing it in other things where I'd either had more interest or more tax protection, leaving it in a bank, it's safe, but your money doesn't work for you, and then you have tax liability. So you need to think about other things. Okay, so we filled the short term. Now the next thing is the long term. So you want to fill up your long-term bucket, okay? So long-term bucket, frequently called retirement. The target is 20 to 30 years from now. But because it's in a long-term investment, it's not liquid. It's difficult to take out. But because it's in the long-term investment, it will tolerate the highs and lows of the stock market a lot better, right? Because you don't have to, if it drops, you wait a few years, it'll be high again. Drops again, wait a few years, it's gonna be high again. And it's all gonna be protected in this long-term bucket. And unlike your short-term, hopefully the growth here is high. So in time, the growth is gonna be high, hopefully. In terms of what kind of things your long-term bucket is going to fund, retirement plans, and we're going to concentrate on that during this talk. Educational savings, like a 529 plan. The best way to think of educational savings is exactly like your retirement plan, but except instead of you being the beneficiary, it's there for your kids for when they go to school. And that money is tax protected to a certain extent, but it's meant for your kids to take out for when they gotta pay you gotta pay their tuition when they go to college. And then health savings account is another type of investment that's a long-term plan. But I wanna concentrate a little bit on retirement. So all of you are probably going, why the heck do we have to worry about this right now? So I want you to think about when you're on the wards and you saw your old professors rounding at 5 in the morning, and you're wondering, man, is that guy working at age 70 plus because he wants to work? Or is that guy rounding at age 70 plus because he has to work? Which one do you want to be? So again, if you want to make it so you're rounding and working at that age because you want to work, you really need to start thinking about retirement right now. So the question is, what is retirement? So this is my group, Aloha Critical Care Associates, and our founding partner, or managing partner at the time, Dr. Haruno, he retired a couple of years ago. And I'm very sure he retired because he was at the point where he didn't have to work and he just wanted to work as much as he wanted to. So he didn't do our job as intensivist into his age, and he's not that old. He retired at a relatively young age, and he's really enjoying his life. So you really got to think about, well, what is this concept of retirement? How can I get to retire at a good age? So again, by definition, retirement is when you stop working. You're not actively working anymore, and that's what most people think of retirement. But at the same time, retirement is probably the greatest challenge of your financial life. Most people in their life, they are working toward retirement, and you'll hear that phrase very often. And I don't think it's any different for physicians, but it's just different in the kind of resources we have to get there. Uh, Full retirement is when an individual can collect a max from Social Security, and that's 67. So if you're born after 1950, which is all of you, um, you really can't get your max Social Security benefits till you're 67 years old. So imagine running to a code when you're 67 years old. I do not want to be that guy. You know, so again, probably a better way to look at retirement is retirement is when you decide that you don't want to work because you already reached this concept of financial independence. So financial independence is when you basically no longer need to work to earn a paycheck because the combination of your savings, investments, and passive income stream can now, you know, outpace your liabilities. So you can support yourself just with this stuff. So how do I get to financial independence? So there's this thing called the 4% rule. It's really a ballpark figure. It should not be taken as gospel because there's a lot of nuances to this rule. It was based on something called a Trinity University study. And what it looked at is something called safe withdrawal rate. So how much money can you take out every year without it running out over 30 years, right? So if you retire at 67, you're probably gonna live till 97 at most. Do you wanna die with zero money or not? So basically they figured out that if you take 4% out of whatever you have, that will make you, and that will make you last long enough. And if we reverse the 4%, it becomes the 25x rule. So what this is if you take your yearly expenses and times it by 25, that's get 25, that'll give you the number you need to reach financial independence. So for example, if I say that I need $10,000 a month to live independently, times 12 is $12,000 a year. So $12,000 a year, sorry, $120,000 a year. So $120,000 a year times 25 equals 3 million. So if I have $3 million in assets, I could retire and last 30 years without running out of money, right? And that's just based on the money you have. That's not taking into other things into account. But again, remember, this is all ballpark. You know, it might be a 3% rule where you can't take out more than 3% or 2%. Or if you have a lot of money, you could take out 5%. It just depends, and there's a lot of calculators. But you know, if a lot of doctors make less than have less than $1 million a year in assets, how are they gonna reach this as their financial independence number? And granted, this might be a lot. You know, I like to live large, maybe 10,000 a month. That's a lot, but you know, but for some people, that's what they need to live. So this is what I need personally to get there. So how do you get this retirement money? So number one, people think Social Security. Yeah, I just need Social Security. How much money do you think you're gonna get per month in Social Security at age 70? We're lucky as physicians because we max everything out. You probably get like $4,000 a month in Social Security payments at age 70 and beyond. But if you want to retire earlier, you're not going to have that amount of money. A lot of times you might have leftover short-term and leftover middle-term money buckets to file your retirement. You know, short-term, again, you're not going to make a lot of money and you're taxed the whole way. And your middle-term bucket, which we'll talk about next time, the negative is you have to pay taxes on it. So you're not going to have a ton of this. So the best way, honestly, to just fund your retirement is to fund your long-term bucket. And all this other stuff is bonus. It'll be gravy at the end of the day. So really, how do I fund my long-term retirement bucket so I have enough to retire? So the bucket itself is really the retirement plan. And in the bucket, you're going to put different kinds of vehicles like stocks, index funds, bonds, mutual funds. And in this bucket, it's going to grow, okay? But the reason this bucket is important is because retirement plans are something that's really specially carved out of the tax law. The government wants to encourage people to be able to support themselves when they're old so they don't have to support you from the government side. So they created retirement plans to give an advantage to people who want to put away for the long term. So these investments are 20 to 30 years. And because they're long-term investments, most of the time you cannot take money out before age 60. And you cannot keep it in there forever. So at age 74, you're forced to take some of the money out. So again, retirement plans is the way of the government creating tax benefits for you so that it will encourage you to save for the long term. So the number one advantage in retirement plans for you all is that time is your biggest asset, because if you put money and start putting money in now at the beginning of your medical career, number one, you're gonna have a lot of time to tolerate high risk. So the stock market drops tomorrow, by the time you retire, it'll guarantee have recovered and probably had more money. So if you put money in now, your money's gonna have a chance to tolerate and withstand the volatility to the stock market. The second reason why retirement plans is important to start putting money into it now is compound interest. And that's why I talked about it earlier, because you start putting money in now, little by little, pay yourself first, put money in now, you're gonna have it grow over decades, and it's gonna grow exponentially by the time you get closer to retirement. So that gold is gonna work for itself that you put in and make more money, okay? So time is your biggest asset. That's why it's important to think about retirement early in your career. So again, if you put in money early, you can, in 20 to 30 years, you could have millions of dollars just putting away a little every month. The second reason why retirement plans are beneficial and why you need to put away money into these plans is there's a lot of protection from taxes. So if you put money in an account that's not a retirement plan, and we'll talk about this again in the middle bucket, every time you make money annually, you're going to get tax on capital gains, and you're going to get capital gains tax on your dividends. But if you put money in a retirement account, you're not going to get taxed at all for growth, right? So again, planning growth because it's there in the account for a long time, and the government's not going to take anything from taxes year to year on you. So it's going to compound even more. So there's two types of, in general, retirement plans, and they're called, the other term for retirement plan is defined contributions plan, which is basically you contribute to your retirement. So one type is pre-tax contributions. And what this means is your company, you get paid before you pay taxes on it, you put it in your retirement account, you hide it in your retirement account. So an example of this would be 401ks, or if you work for a nonprofit, 403bs. And if you're work for yourself, then you have a solo 401k or something called an IRA, which is individual retirement accounts. Another type is post-tax contribution. So basically in this one, you get paid, I'm gonna pay Uncle Sam my taxes now, and then I'm gonna put it into my retirement account. And an example of this is a Roth IRA. So a Roth IRA was a tax law created by Senator Roth. And what it does, again, it's post-tax contribution. So you pay tax on the money first, and then you put it into the IRA. So when it's in the when it's in the Roth IRA, it's gonna grow tax-free. So whatever you have in there, like if you have a mutual fund, it's gonna grow tax-free for the whole time it's in there. The negative, again, there's some rules where you can take some money out, but in general, you can't really touch it till age 60. But more importantly, because you paid taxes on it already, anything you take out of it at the end, you never have to pay taxes. So you pay tax before, put it in, it grows, but now you never have to pay tax on any of that growth ever again, right? So, man, that's magic, right? I paid taxes, it grows, and Uncle Sam's not taking up what's coming out the other end. The only caveat is there's a limit of $6,000, at least now this year, it's $6,000 per year contribution. And unless you do some fancy paperwork, it's limited to people who make under $125,000 a year. But we do have fancy ways for you to get around that. So technically everybody could do a Roth IRA. 401k, pre-tax contribution. So again, they pay you before you throw it, before you pay Uncle Sam, you hide it away in your 401k. And money, just like the Roth, is gonna grow in there. And you cannot take it out until you're age 59. So then um, the difference between a Roth and this is when you take your money out at the end, because you never paid taxes on it, you gotta pay taxes on your 401k now. However, they're gonna charge you taxes based on your income tax rate the time you take it out. So for example, if I'm making $500,000 now, I would be in the 37th tax bracket and get a, well, I think it'll be pretty high up, 30 something percent taxes on it now. But later on, if I take my money out when I retire and I'm only making $120,000 a year, they might only charge me in the lower tax bracket, which could be like 22%. So I'm saving taxes anyway. So this is another way. So again, it's not as good as the 401k, but it still benefits you because you save taxes across the board. And I'll show you one more reason that's true. The other good thing is your limit's higher, 19,500 if you have a 401k alone. If you have profit sharing that ramps up to 58,000 a year, you can put away. And I'm sure most of you are going, I don't have $58,000 a year. Yeah, you do. You don't just know it yet. So the other advantages for the Roth IRA is you should think about putting money in a Roth IRA as soon as you're a resident, because say you're putting away $6,000. As a resident, you're in a 22% tax bracket, for example. You're only going to pay you're going to use $7,320 to put away $6,000, right? Because the remainder is taxes. If you're doing it as an attendant, you have to pay a lot more money to put away $6,000. So the lower your income rate is, you should put away as much as you can in your Roth, because it'll never be, you basically will pay less taxes on it lifetime. So one thing to consider is, as a resident, put away Roth IRA. When I was a resident, this law wasn't in existence yet. So I didn't get to put it in Roth because it didn't exist until like 2010 or something like that. But for all of you, this is something to think about. 401k advantage, again, as we talked about, another advantage is employer match. So most of the time, if you sign up for a 401k, your employer, your boss, is going to say, I'm going to match 4% if you put away 4%. So for example, if you commit to put away 4% of your total of your income into the 401k, the employer is going to match it and give the same amount. And this is free money, okay? Always put away whatever your employer is going to match, because otherwise you're letting that money go to waste. It's free money. You're leaving it on the table. So another tip is, if you get a 401k, please put away whatever is being matched. And the tax savings, as we talked about, lower taxes. But the other thing to do is, if you put away money to your 401k, the other advantage is it'll actually adjust your tax rate. So for example, if I got paid $215,000 a year and I put away almost $20,000, I'm gonna move from paying taxes here to not paying taxes on 19,000, and anything I have is only gonna stop at this tax rate. So if you put it away, at least today, I'm not gonna pay 35% on this $19,000. But when I take the money out in 30 years, because I'm only gonna make $120,000, I'm only gonna pay 0.24%. So at least at the end of the day, I'm gonna actually save like 11% on taxes, give or take, a year. So again, it's always advantageous for you to max out your 401k and let it grow over time. Okay, so that's retirement in general. So any questions before I go to the closing tips?
There's a question about going back to banks.
Yeah, sure.
I've heard that credit unions may be good if your finances are simple, such as a resident. Is this true? Do you have any advice on credit union versus in-person banks versus online banks?
I mean, in a lot of ways, credit unions are kind of the same in terms of your personal experience with them. I mean, some potentially may have higher interest rates. The flip side of it is you might not have as many banks you can go to. So I definitely think it's definitely an option. I think I would just like research all the banks first and then figure out who gives you your best advantage, whether it's availability, what are their fees when you're taking money out of the ATM. Some banks or credit unions have more fees when you're transferring money out. Um, I personally think you have some kind of local bank, which is a credit union or a brick and mortar bank. And then I would have a online bank to put my savings where I can at least take advantage of the little bit higher interest rates. And then you can move money in between fairly easily, I think. But I think technologies have put a lot of the credit unions and the bigger banks on par. The bigger banks become more of a factor later on when you need higher end banking stuff like getting loans or business loans or physician loans to buy your house. I think that's when having actual bank accounts in the bigger banks mean more. And I think there's things like private banking. So you have a lot of money sitting in your account. You have a lot of perks. You have your own banker, it's like flying first class. So some of the smaller credit unions may not have that. But again, as a resident, like you said, if you're simple, it's probably good enough. But I would just weigh its availability and its benefits compared to other local banks. But I would still do an online bank is what I would suggest.
Yep, that's it.
Okay. In closing, tips just throughout the talk. So number one, I think when you're a med student, practice spend less than you earn, right? And med students are good at this because pretty much your net worth when you're a med student is negative, right? Because you're in loans. But whatever you do, try not to create too much debt. They did this study on Medscape and they said on average 25% of physicians have more than 7 credit cards, which is crazy. Don't sign up for too much credit cards. Just get like 1 or 2 and make sure they're the good kind, okay? And as a med student, my tip is start your trip toward financial literacy. So if you're here listening to the talk, you already started it. I think you're way ahead of where I was, and I think that's super good. When you're a resident, like Hazel and Terry said last week, asset protection should be one of your number one things, especially when it's cheap because you're a resident. Start trying to live a reasonable life and start learning this concept of paying for yourself first. So when you pay for yourself first, then fill your short-term bucket, make sure you have at least $1,000 emergency fund. I think that's baby step, easy to do as a resident. Some people actually put their emergency fund like in an online savings account that's completely separate from any other account, so you're not tempted to touch it. If you don't have a 401k in your residency program like like HRP, I would definitely create a Roth for yourself. And for the Roth, you only can put away earned money. So if someone gave you money, you can't put it away, but you can definitely put money in there. But again, use that concept to pay yourself first. So $6,000 divided by 12, that's how much you should put away each month. And you can create the Roth easily online through Fidelity or Vanguard. And you can tell it to, hey, pull $50 a month or $500 a month or whatever you want into the account, and then it'll do it for you and you'll never miss it. And then as a resident, don't worry too much yet about your loans. Like start figuring out what to do, but find a way. Like don't think you got to pay it all off right away in residency. That's not what you just really do not want to create too much liabilities. The moment you become attending, live like a resident for 2 to 5 years. Have fun, live your life, but don't go crazy in terms of your expenses. Again, keep paying yourself first. Expand out from the $1,000 to what is 3 months expenses as an attending living a resident salary. Make sure you have that in emergency funds. And then immediately start filling your long-term bucket. If you're offered 401k, put in minimum the match, but honestly, try to maximize what you can put. You can put the 19.5, or if you're profit sharing, you can put up to 20 to 25%. The earlier you start, the better. And then for some of us, we luckily had enough to max out our 401k. I would have maxed out my Roth IRA on top of it if I had extra money. But again, you want to probably pay some of your other debts down too before. No, but I think in general, it's really like make sure your retirement funds are squared away, long-term bucket. Well, sorry, make sure your short-term bucket is square, fill the long-term bucket, and then and part of that too is start paying down debt with your extra money, and then think about your taxable income, which is hopefully what we'll talk about next time. So next episode, we haven't picked a date yet. We'll talk about taxable income in general, and then maybe a little more info on mutual funds, stocks, bonds, and alternative investments, which is real estate, Bitcoin, yada, yada. But
Those are the
that's,
fun stuff. Okay, I have a question for you, Dr. Ganitano.
yeah,
How would you go about deciding the proportion to go to your short versus long-term wealth accumulation buckets?
great question. I did the wrong way because I probably put in like, I wanted to see my bank account go as high as I could. Just like my unanswered emails. I don't know, I've shown some of you guys that I have 100,000 unanswered emails and I'm doing it for fun. A lot of people say that you should only keep what you need in the short-term bucket and then fill the long-term bucket. And if you have extra, then start putting it into this middle term. So for example, what do you need to run operations in a month? So do I just need 30,000 in my checking account and always just keep it at 30,000? And then whatever I get paid extra, I move it in, make sure like, so for example, I got my emergency funds done. I filled my operations budget. I have enough to pay my bills. And then a lot of it's going to depend on, do you have any short-term goals? Like, so am I saving for a house, a car, whatever? But if you already have your car and stuff like that and house, then, okay, fill the retirement side as much as you can. And then once that's kind of filled as much as you can, so say you max out your 401k and you do a Roth and you fill that out. Instead of accumulating money in a short term that you're not going to use, that one I would invest in your middle term buckets so that your money is at least earning more than the 0.01. So example, for me, my retirement was squared away. I always maxed it out. I made sure all my bills are paid, but I accumulated a lot of money in my savings. So it's sitting there for years earning 0.01. Whereas, I probably could have just left $100,000 in my savings in case I needed, short-term buys, and that other whatever hundreds of thousands of dollars, I should have put it into my middle-term investments into stocks and bonds, where I would have at least earned more like 5 to 10% rather than 0.01. So what I've learned is don't let your short-term bucket be too big because you're not letting your money work for itself. And a lot of this is personal, I think. I don't think there's a magic number. I think you just gotta, how safe do you feel? I'm currently I'm weaning myself down from seeing a big bank account into one where I have minimal and I have to trust that the money's still there. It's just someplace else. But that's my kind of take on it. I don't know, Hazel, what do you think?
Yeah, I am 100% on board with that. We have our emergency fund, which is our immediate short-term emergency funds, and that's sitting in a credit union on the mainland. And going back to that question about credit union, I don't mind using a credit union on the mainland for an account that I'm not going to touch, where I don't have to interact with someone from customer service often. But if it's a bank, an account where I feel like I'm moving money in and out a lot, and if I have issues, I need to be able to call someone up right away, I would go local just for the convenience of it. And then just like Dr. Ganitano, we max out our pensions and whatnot, but in our bank account, I have like a little bit of a cushion, maybe a couple of thousand, just to make sure that we don't go negative. But
Yep.
everything else after that gets invested, and it gets automatically invested, just like what Dr. Ganitano was saying. Automatically, it's going to index fund. Automatically, it's going to Roth. Automatic, it's going into what Dr. Ganitano is going to talk about next time. So we don't see it. And like you said, we kind of feel poor sometimes relatively because our account doesn't look high, but we know that it's going into long-term investments and making us money. And so hopefully that answers your question, Tiffany. Okay, and then going back to Emily's question. So Emily's gonna be an MS1. What is your advice about medical student loans and how to manage it in med school for you, Dr. Ganitano?
I'm probably not a good example of how I manage my loans. I and it's very different now for you guys. This is a whole talk in itself. I would definitely ask your financial aid department and ask the senior residents, because and the residents and the med students, because there's a lot of different ways for you to pay your loan off. I would be wary of certain things. Like like to me, like a lot of people say, "Oh, should I join the military or should I do, a lot of this work in underserved area repayment stuff?" Personally, I think if you want to serve the country in the military, it's fine to go military. If you want to go serve in an underserved area because that's what gives you joy, go do that. And the secondary benefit is to pay off your loans. I don't think there's a need to do those things just to pay off your loans, because you're going to be a high enough earner down the road. And there's a lot of different ways. So again, if you want to serve and you want to do those things, please do it. But don't think that that's the only way that you're going to pay your loans off. And again, I I do not want to speak too much about how to manage your loans, because to be frank, there's so many ways to do it now. Obviously for you, Emily, as a new person, try to get as much scholarship stuff as you can get. It takes a little work, that always helps. And again, obviously as much subsidized learning as you can get, right? Or federally subsidized loans as you can get, and try to avoid as much private loans as you can get. And then I think at the end of the day, it's really what I did not have a good understanding of is what would repayment look like as a resident and a new attending, and can you refinance your loans? I think that would be another thing. Hazel, I think, had shared a website or link to was AMC website on loan repayment. That might be a better resource than anything I could tell you. Not to make you guys jealous, but part of it is my age. Man, Japsam in the old days was cheap, like half your tuition was tuition waiver. I honestly walked out of 4 years of med school, 1 year being a year where I didn't live at home and I took the higher budget. I walked out of med school with $45,000 in loans. That's it. And again, my parents paid my undergrad. So I probably should have paid it off in one fell swoop, but I paid it off over time, which I probably end up paying $100,000 by the time I totally repaid the loan. So don't do that part. But again, look at other resources, but more importantly, gain a good understanding. And again, don't feel the emergent need, regardless of your situation, to go military or go underserved repayment, because there's a lot of caveats to that. Again, if you want to do it because you want to serve, please do. But I've also known friends, like I had one friend that he did like Native Hawaiian repayment, and he had to work in a federally funded community health center. This is about Jason, and he almost couldn't get hired because none of them wanted to hire doctors, because doctors are more expensive than NPs, and he was almost unable to find a job in which to get that would help him repay his loan. So there's some caveats when you look at these things. So I just look at everything in a lot of detail. But again, I would say don't be afraid to take out loans.
Yeah, I agree with that. Take out what you need to survive your med school years, but don't take too much that now just becomes you're using that money to buy luxury stuff, excessive stuff that aren't necessary. Like paying for your wedding. That wasn't necessary.
You use
Okay.
your student loans to pay for your wedding?
Good. We took out the residency and relocation loan in fourth year to pay for our wedding. Smart move. 8% interest rate. Looking back, I wish I had done things differently. That's all the questions that we have, Dr. Ganitano, as far as I can see. I do want to touch on the Roth IRA thing. If you do have room in your budget, I remember being a resident and my husband was telling me, like, you know, some of our classmates are doing this thing called Roth IRA. They're talking to his financial advisor and then they're doing it. And I was like, no way, we're not doing it. We'll just start saving when we're attendings. And then we came out, then 3 years later after residency, we're like, I should have done Roth IRA. It didn't take that much money. And the part of the reason why I didn't do Roth IRA is because my understanding at the time, when we were residents, the max was 5,000. I was like, we don't have 5,000 times 2 to put away. We'll just do it later. But one of the things I realized, you don't have to put in max. You can put in 2,000, you can put in 3,000, whatever little you have. And if there's no pension in your residency, and you can save some, I do recommend to start a Roth IRA. It's super simple. I know it sounds daunting, but there's a lot of websites, there's YouTube videos that walk you step by step on how to do it. I do it at Vanguard. So please, please, please don't overlook the Roth IRA for residents, especially if you're here in Hawaii. Yep, that's it.
Okay, well, I hope that was helpful. When I first started thinking about this talk, I was like, well, I just want to talk about stocks, bonds, and whatnot. But in the end of the day, the behavior stuff is actually the most important stuff if you really think about it. And if I think about what lessons I learned and I should have done different, it really would have been to change my behavior at least a little bit. You don't have to be like, if you start reading about finances, you're going to always read this stuff about FIRE, which is financial independent, retire early. Man, those guys, I don't want to do that because I don't want to drive a used car for the rest of my life. And you don't have to be that frugal to do it. So, but again, live your life, but just really be reasonable. I think about your future and live a reasonable life. And again, when you're a resident, don't freak out too much because eventually the money is gonna come. Just again, use residency honestly to practice your behavior. So when you're attending, it doesn't go too crazy. Don't be ashamed. Like honestly, my parents never pay for anything when I take them out. Don't be afraid to pay your loved ones back because you have more money. Don't be afraid to spend on them because you're trying to get to FIRE. Like you owe them a lot more than just financial. And hey, treating your parents to a nice dinner, I think that's a really good gesture to have. When my dad retired, I bought him a truck because I could, and that is their compound interest, is your ability to be successful and secure, and that's paying back. But don't be afraid to treat your loved ones, your friends, family a little bit here and there. And honestly, really, don't be afraid to pay back. I mean, pay forward. I mean, one of my mentors was Jinichi Tokeshi, and that guy literally took us to fancy dinner all the time. And I take every opportunity to treat my trainees because, again, I think that's what we're supposed to do as attending. So again, when you're the resident on and you have med students, buy them coffee once in a while, or vice versa, and pay it forward. So I think wealth is a lot of different things. So that's my story for part one. Hopefully that went okay, and hopefully we learned a lot.
Okay, everybody, thank you so much. So the recording for this video is going to be on our website. It's on the same website that I had emailed you with our videos from last week. So thank you, everyone. The date for part 2B, part 3 of Dr. Ganitano's talks, we'll let you know. And we know you're all busy, but thank you, thank you, thank you.